Hello there and welcome to Project Business Basics, designed to give you the tools to make smarter financial decisions. Whether you're looking to learn something brand new or just want a refresher on some basic economics, there's a place for everyone on our show. I'm Archit Janarkar and I'm your host. Today we're going to be discussing bank accounts. Now when we talk about them today, it's by no means a comprehensive list of all types of accounts. The accounts that are available vary by the bank that you use or the area in which you live, but we're just going to go over some of the most common bank accounts that are seen. So first, let's talk about a checking account. Now with the checking account, you have money in the bank now. You also have expenses to take care of. You might spend some of this money on food, or maybe getting gas for your car, or maybe paying for health insurance and visiting the doctor. So in order to pay for these expenses, what you do is you end up drawing money out of your checking account. And you're drawing money out, so you're probably going to end up having to add some money back in through the income that you earn. Now let's go and talk about a certificate of deposit. And we've talked about a CD before on our show. And how CDs work is you put your money in the bank, and the bank says for X amount of years or X amount of time, we'll pay you Y% interest on your money. And the reason why they do that is they want you to keep your money with them. So with CDs, you keep your money in the bank, you earn interest, and you don't withdraw it. Now we'll talk about savings accounts. Now for savings accounts, it's best to understand them in the context of the previous two accounts we've just talked about, a checking account and a CD. Now the way we're going to think about these two is we're going to think about it as if it's a spectrum, where on one side you have a checking account, and on the opposite side of the spectrum, you have a CD. And in the middle of these, but closer towards the CD side, is a savings account. And the reason why it's closer to the CD and not as close to a checking account is because the savings account, as you can probably tell by its name, is trying to get you to save your money. And that means that you don't withdraw your money very often. With the checking account, you're constantly withdrawing to pay for your expenses or whatever you might be using that money for. With the savings account, you could withdraw just like you do for a checking account, but you're not supposed to. You might use the savings account money only in emergencies, or if you really need the money. So savings accounts are not very liquid. When we say liquid, we talk about how fast can you get your hands on the money that you have. Checking accounts are very liquid, because you can access the money through either a debit card or through sending a check or at the ATM. For a savings account, though, it's not as easy to get to the money that you have in that account. With savings accounts, what banks do is pay you interest, just like with the CD. Now the difference, though, is that CDs are going to have higher interest rates given to you, the depositor, than savings accounts. And the reason for that is because when comparing savings accounts and CDs, people do withdraw money from savings accounts through those situations that we mentioned. So because people end up withdrawing their money sometimes, banks will give lower interest rates for savings accounts than they do for CDs. Now let's move on to our final account. And to do that, let's zoom in on the savings and CD part of the spectrum. Now if we do that, if we zoom in on that, then in between savings account and CD, you get what is called a money market account. And money market accounts have very low liquidity, just like savings accounts and CDs, but even less liquidity than savings accounts. So the money is not really meant to be withdrawn. Where it's different from both savings accounts and CDs is that it has variable interest rates. Generally with CDs or savings accounts, the interest rate is set at the time of deposit. Whenever you put your money into the bank, whatever interest rate you get at the time is going to be the interest rate you get for however long your money is deposited. But with money market accounts, the interest rate varies depending on how markets do. If, let's say, the Federal Reserve, like we had talked about in one of our very early episodes, they lower interest rates, well then probably the bank is also going to cut your interest rate that it's giving you in your money market account, or vice versa if the Fed raises interest rates. Okay, so let's recap. We talked about 4 bank accounts that are commonly offered by banks. The first was a checking account. Checking accounts, you put your money in the bank, and when you pay for expenses, or whatever it is, you're going to probably withdraw from your checking account. And you withdraw money from it, but you also are most likely going to add more money to your checking account whenever you earn income or you get your paycheck. Then the second type of account that we talked about was a CD, or Certificate of Deposit. With those, you put your money with the bank, and you don't take that money out pretty much. A bank will give you some interest on that money for a set amount of time. You can't take your money out within that time in most situations. Then we talked about savings accounts. Savings accounts have some of the features that are seen in both CDs and checking accounts. With savings accounts, you're meant to save your money. You're not really meant to withdraw it, but you can do it if an emergency arises or something else occurs. But you do get interest from the bank for your money that's in a savings account. But the interest rate that you do get for a savings account is generally going to be lower than the interest rate that you might get for a CD. And then finally, we talked about a money market account. Money market accounts are also not designed for high liquidity. You're supposed to keep your money in there and not really withdraw that often. But the difference for money market accounts is that they have variable interest rates, where the rate varies depending on the market or the Federal Reserve's interest rates, for example. I hope you enjoyed that episode and learned something from it. If you're looking for recommendations for good investing and business books, I encourage you to check out the Project Business Basics blog and also sign up for the Project Business Basics newsletter. You can do all this through the Project Business Basics website, which is www.businessbasics.online. Also, make sure to check out our social media. We're on Instagram and Twitter with the username @PROJBIZ Basics. I'm Archie Janarkar. This is Project Business Basics. Thanks for listening.